My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is Lawson Steele, who thought yesterday was today in the scheduling of the Twitter space. But Lawson, I've seen some of your interviews. I'm actually quite excited for this conversation. It's a good topic to focus on. Introduce yourself. Who are you? What's your background? How'd you get involved in markets, and why the carbon side?
Hey, Michael, thanks for having me on. Yeah, yesterday, today. I got my, as we say in England, my knickers in a twist. I thought it was happening yesterday. Anyway, who am I? I am, by background, a guy who's been an institutional equities analyst for 35 years, covering for my sins utilities. And as part of that, I've covered the European carbon market since 2004, the year before it began in 2005. I covered that simply because carbon price is an important component of the electricity price, and you can divide, broadly speaking, you can divide utilities into two groups: the really dull lot, which are all about regulation and all that stuff, which bores me senseless. And then the other lot, which are actually quite exciting, which are all driven by commodity prices. So you need to understand what the hell's going on around the planet, really, when the electricity price is being set by market forces. And therefore, carbon was an important component. I started covering in 2004, as I said. In January 2006, I reckon the thing is going to crash to zero. I put out a note in January 2006 saying it's going to zero. It's trading about 30 at the time. And 11 months later, it literally went to zero, which is, if you think of any commodity, it's going to zero is extraordinary. And then I got seriously bored because I know the system was just oversupplied. The carbon price was trading around 4 or 5 euros. And then in January 2018, when it was at 8, I got super interested again and become a mega bull. And today we're trading at, I think, at 80, 81 or so. So it's been a 10-bagger, even got up to about 100. And I think it has a lot more upside, although I'm a little bit more cautious in the short term.
All right, so between that zero print in 2006 to 2018, presumably you've focused your attention and energy elsewhere. I mean, where else were you looking at from an investment perspective, and was there maybe a catalyst in 2018 for you?
Yeah, I mean, basically what happened, I mean, you've got to understand what this system is about. So maybe we just need to sort of talk about that first. The European carbon, just get its proper name, the EU Emission Trading System, the ETS, is a system which was put in place by the EU in order for them to achieve their 2030 and 2050 climate goals. It is their most important weapon in that fight. So the carbon price has to be sufficiently high to make it worthwhile for somebody who's emitting emissions to say, actually, the price is so high, we should actually try and decarbonize. And the way the system works is that every 30th of April, although that's changing next year to September, every 30th of April, you go cap in hand to the EU, to your actual government, and say, right, forgive me, Father, I've sinned. I've emitted 10 million tons of carbon. Here it is. It's audited. It's for the last calendar year. To which the EU says, or the government says, right, give me your 10 million European carbon allowances, EUAs. And if you do that, that's done and dusted. If you don't do that, there's a significant penalty, which we can talk about subsequently. With that in mind, you have an annual requirement to deliver these allowances, and therefore you've got to get them. Some are given to you for free for industry, zero for free if you're power, and the rest you've got to buy in the market. But if the price has been 4 or 5 euros, it's done nothing. So really, this system from 2005 to 2019, I'd venture to say, so a good 14 years, was a complete disaster. And it wasn't until 2013 where the EU came up with these ideas to try and resuscitate this price, so that you get to that point where carbon becomes important. But they had all these idiotic ideas and thoughts which they put in practice and were useless. I mean, I knew they were useless from the get-go. And then in November 2017, they came up with this new thing, which was designed to cut supply quite aggressively, called the MSR, the Market Stability Reserve. Sorry, but it's got a few acronyms. But anyway, so the MSR kicks in, and I thought, oh God, here we go. Here comes another useless piece of legislation from the EU. I better adjust my model because I haven't looked at it for a couple of months or whatever it was. So I thought, well, it'll take me a couple of hours. It took me 6 weeks, right? Not 2 hours, but 6 weeks of looking at this thing, saying, surely I misunderstood. This can't be right. Let's check this. Let's check that. And eventually I realized that what they were proposing and came into legislation at the beginning of 2019 was huge. And it is, and that's really what made me become a mega bull. The system as it stands has an annual reduction in the amount of allowances, the EUAs, which are offered to the market, either for free or auctions. Auctions happen almost on a daily basis. They typically declining by about 2-3% per annum. That's going up to about 4% from 2024 in order to reach that 2030 target. So we knew this back in 2008, okay, that you have a pretty straight downward trend, which has become steeper now because they've got more aggressive with the 2030 target. But what they put in place is that under certain conditions, they will take out a huge swathe of additional supply. And that's what came in 2019. And that's why in January 2018, ahead of that, I realized what the hell was going on. And I, went off and spoke to about, I don't know, I must have spoken to about 750 institutional investors.
In those conversations with these institutional investors, what's the response? Is it seen as somewhat of a more esoteric part of the investment landscape? Is there increased activity? I mean, I can tell you that I'm sure you've seen the carbon ETF from Crane Shares, right? Got quite a bit of attention, raised $1 billion+ in assets. But I get the sense that, at least in the West, most individual investors and financial advisors have no clue about this part of the market.
No, I mean it's you're right. I think it has been, well, it started off as a niche, right, and it's slowly gaining more notoriety, and I think with it will come a wider investment base. But it started off, I had a number of conversations. I remember one guy in Atlanta, for example, where I went in, not to name who it was, etc., but a pretty large investor, and I told him the story about carbon. It's very interesting. Yeah, okay. And then I went back, 4 or 5 months later on another marketing tour, and I said, oh yeah, and carbon. Oh yeah, tell me about that again. So I had to tell him. I told him 4 times before he eventually sort of took it on board, because these guys are busy doing other stuff and everything else, and they haven't got time to I don't know, think about something new. But eventually they have to. And the interesting thing about carbon is that it is a completely new asset class. It's not a share, it's not a bond, it's not a commodity. It is a separate asset class, and as such, by the way, it is a fantastic investment because. Rule number 1 of portfolio theory, as you know, is diversify. Preferably, that means that you diversify with assets which have low correlation to each other, so that sometimes when one's going up, the other's going down, and one's going down, the other goes up, and it essentially reduces the risk of your portfolio if you get it right. Well, EUAs have a very small correlation with other asset classes, 0.2 to 0.4, and what is more, are rising in price. So for me, generally, when I sit there objectively, I think, why doesn't everybody have this in their portfolio if they're allowed to? And the if bit is important because pension funds, are only allowed to invest in equities or bonds, for example, or they might have a remit which restricts them. But ultimately, this is for me, it's a complete no-brainer. Why wouldn't you have that in your portfolio?
Yeah, well, I mean, I think part of the problem is that it's oddly enough sounds politicized in the U.S., whereas in Europe it's just kind of a way of life, right, in terms of the way that the system works. And there's also, I think, just the broader issue of length of time, right? It's still a fairly small market and hasn't been around that long from a liquidity perspective to make it worth sort of doing portfolio optimization on.
Well, it's a $750 billion market. That's not small.
Yeah, it's a fair point. I mean, I would argue that Bitcoin is still a small market, right? And I think it's interesting because I interview a lot of different individuals when it comes to this space and the cryptocurrency space as well. And a lot of the arguments are similar, and a lot of the constraints I think are similar, even though they're two totally different dynamics.
I'll accept that if that's your view.
So you obviously got it at the right time, made quite a bit of money on it. What are the ways of getting exposure? I mean, you did it yourself, but most people probably are thinking they can't exactly put a ticker for exposure to the space.
Yeah, I mean it's for the private individual, or for most people, shall I say, it's difficult, because really what you want to get hold of is the physical European carbon allowance. And to do that, it's let's say it's nigh on impossible for the average punter. You can invest, as you mentioned, in ETFs like Crane Share. The problem with that is that it does not give you the physical exposure. So first of all, you don't have the same impact, because they're using futures, right? So the future multiplier on the physical is like 40 times, so you're having a 40th impact effectively, as you would if you had a physical. You also have the issue that you don't actually own anything. You've got a slice of an ETF, but it's not actually owning anything. And also you're not having an impact not only on the price, but actually not having an impact on the green element either. So that's why I joined Kukubi about a year ago now, because these guys knocked on my door and said, look, we know a lot about blockchain. We want to put carbon on, physical EUA carbon onto blockchain, so that it can then be utilized by anybody, whether it's on-chain or off-chain, but makes it accessible. But we don't know a lot about carbon, so can you come on board? So bizarrely, for some reason, they thought I did. So it's been quite interesting. And now what we've done is we've bridged that $750 billion market on chain. And therefore you can buy. So it's quite simple. So basically you put $1,000 in, say, whatever currency, we buy the carbon allowances, and then you mint a token 1 for 1, and you own that token, which you can then reverse and take delivery of the EUA if you want to redeem it, or you can take cash, whatever. So it's completely flexible. So you don't have all the headache and hurdle of buying EUAs, because we do all that. But you ultimately own a token, which is backed always at least 1 for 1 with an EUA, if not more. So that means that you then have an asset, which is having the direct impact on the price, because you're withholding it from the market, forcing a tighter supply-demand balance. And you have, it's a super green investment. And also you can then leverage that asset if you want to start doing lending and whatever, right? So those are the two basic ways. I mean, it's impossible to buy the physical as an average punter. You can get the ETF, but if you own a Kukubi token, then you have 40 times, the impact of the underlying or the future.
Is a question on the Twitter thread from XHope. Talk about dirtier industries, aluminum, steel producers. What are they doing? What are some of the costs they're dealing with? How does it affect consumers? Scope 1, 2, and 3 emissions. Any thoughts on sort of the carbon movement and industries which are not exactly adept for that dynamic?
Yeah, I mean fundamentally, I don't think I'm not a great fan of a market where you have just one supplier. So it's kind of interesting that, given that dynamic, I like what they're doing. I like what they're doing because actually, well, I think the supply demand dynamics are fascinating. It's a 10-year deficit of supply. Supply will not meet demand in every one of the next 10 years. So that means obviously the price has to go up quite a lot. But it's also quite a clever system because they know, right? So if you've got, for example, an ArcelorMittal, a steel producer who says, you know what, I can go and produce this steel anywhere in the world. So if you dick around with a carbon price which is present in Europe but not present in, I don't know, Ghana, or wherever I want to go and build steel, then I'm going to shift. So the EU says, okay, we don't want that to happen, because if you up sticks and go and produce elsewhere, then clearly it doesn't do the climate any good. Probably it's slightly worse because Ghana have less carbon sort of restrictions, shall we say, and also we've suffered an economic loss. So in that case, we will allow the state aid rules to be bent, and they offer them free allowances. So therefore, those industries are protected in the sense that their carbon cost is de minimis. What is interesting going forward is from 2026 onwards, really, or the beginning next year, but probably more with bigger bite in 2026, is they're putting in place something called the Carbon Border Adjustment Mechanism, CBAM. I told you there are acronyms. And CBAM's quite clever. CBAM says, right, look, if you want to come and sell into Europe, that's fine. You can do it under the usual rules. But you've got to be on the same carbon footing as the domestic players. And therefore, we will impose upon you a carbon border adjustment, which means that if you have no carbon cost at home, or whatever carbon cost you have, you can net that off against the carbon price in Europe. So let's call it 80 euros. So you will have to pay a notional 80 euros to put you on the same level playing field as the domestic producers. And then everybody's happy and you can't quibble about inconsistencies in the treatment. At the same time, if an industry is receiving, as it is today, those free allowances and the competitors are having to pay a full carbon cost, well, that's not fair. And therefore, the free allowances are going to get sort of reduced pretty dramatically, pretty quickly. And consequently, everybody will have a full carbon cost. And of course, those free allowances, which are no longer given out for free, will be auctioned. And that will increase the market size as well, commensurately.
Yeah, I'm always of the mindset that you have to have the view that things run in cycles, right? And I understand that this is sort of a set cycle in some way because there's a constant reduction of the amount of supply. But is there anything that could cause the carbon credits market to have sort of a sustained bear market or sideways type of dynamic, whether it's global recession or maybe some unintended consequences of some new law that's passed? I mean, what could drive the carbon credit market to be stagnant again?
I mean, right from the start of my sort of 2018 bullishness, the 6 weeks I spent and so on, I was thinking, okay, what can go wrong here? And the reality is there's two things: economics and politics. Economics, we've been through a pretty severe recession last year. We also had an unanticipated war. We had social hardship, all that stuff. And although demand has come down, the reduction in supply has outweighed that, and you ended up with a deficit last year. This year, we have a similar situation, particularly as the gas price comes down relative to the coal price, so it becomes more economic to produce electricity with gas rather than coal. And if you produce it with gas, you use half the emissions that you have with coal. So therefore, ultimately, it reduces demand or emissions, if you like. But even so, the reduction in supply outweighs that. The biggest challenge always, the biggest pushback when people said to me, well, what can go wrong? Right from the start, I said politics. Because this is a scheme set by Europe, and therefore you can change the rules. But you can't change those rules quickly. For example, if we woke up tomorrow and they shifted the goalposts, two things happen. One, people say, I'm out of here. I don't care what laws there are. I'm not complying. You can't change rules like that. And secondly, I'm going to sue the pants off you. So they would absolutely kill the market. And the EU knows that. And in fact, if you look at every single legislation they've passed, it's been well thought out, well deliberated, ad nauseum, actually. Everybody can contribute, even the man on the street. If you look at the Market Stability Reserve, that supply reduction mechanism, which came in 2019, that took 4 years of debate. If you look at what they've just passed, the Fit for 55, where they've reduced the 2030 climate target, made it more challenging. That's taken 3 years. So everything they do has to be deliberated, really, with a lot of advance warning and everything else. And actually, if we think of where we are today, they've just spent the last 3 years debating changes, and they've just passed them. Right, they have to be rubber stamped, but that's just that's going to happen the next couple of weeks or so. So they're not going to pick up the baton again and go through the same process. Now, what would trigger a political debate? What would trigger a political debate is if the carbon price gets to such a point, such a high level, that you think, hang on, something's wrong here. We're going to do something about it. So you're going to have the ride up, and if the ride up is super fast and super high, or just slower but super high, then you will have that debate.
Sort of a victim of its own success, essentially.
Yes, but the other thing to take into account, right, is this is good for the EU, right? Because you've got 27 member states, so the EU does the bulk of the auctioning. They collect those auction revenues and distribute them immediately to the 27 member states' finance ministries. So it's a fantastic source of revenues. And to put it into context, we're talking about 60 billion euros a year, which, to give that context, is 1.5 times the Brexit bill, which was 40 billion. But that 60 billion is not only recurring, as opposed to the one-off of Brexit, but if I'm right, is going to triple, quadruple from where it is, and probably more actually, because they'll auction off the free allowances as well. So it is a fantastic source of revenues. So yes, there will be governments which rumble about it and will whinge about it, and there'll be politicians who are paid by industries to make noise. But the finance ministries bloody love this, so much so that the EU is trying to find ways where it can get a share of those 60 billion, and of course the carbon border adjustment mechanism will be in the EU revenue source. So it is, you can be as cynical as you like, but ultimately, these guys are getting paid a lot of money for this, and it's huge. It's really important source of revenues.
The perception point, I think, is an important one. I mean, you use the term, it's a scheme set by Europe, right? And in the U.S., people want to make money, but there's home bias, which means they, probably wouldn't necessarily want to do anything related to Europe to begin with. But also that it seems that it's hard for people to sort of get their mind around the idea that this is not going to stop, that this is a trend that is not going to reverse. Last year, there's a lot of talk about how the pendulum swung so far in the direction of green and ESG and carbon, that it was due to come back, and you haven't seen any give back on that. Talk about, for the audience, sort of the difference in perception of different parts of the world to carbon credits. Presumably, the West really doesn't. Most investors, individuals in the West, they don't really care so much.
Yeah, I mean, there are a couple of things. First of all, it's one planet, so whether we reduce the emissions in Europe, in Timbuktu, or wherever else is irrelevant, right? I mean, in fact, I was reading something the other day that there's some 2 disused or defunct oil fields in Turkmenistan, and they are emitting as much emissions as the whole of Europe, and they're doing that, and all they need is 19 parts fixing, and then you can stop those emissions. I mean, it's insane. Anyway, I digress slightly. The bottom line is you shouldn't really care where the emissions are going to be reduced, as long as they're being reduced, right? Because it benefits every single person on the planet. If you have an issue about, I used to live in New York, so I understand the position of, I'm in the States, why should I care about anything else? They've got a huge market here and whatever. If you've got that mentality, then nobody can shake it out of you, right? But there is a big picture out there. And when you have, if you look at the States, you have, if you look at the carbon emission trading schemes around the world, you've got WCI in the West Coast in the States. You've got RGGI on the East Coast. You've got, obviously, Europe. You've got UK, Switzerland, New Zealand, and then a few other smaller ones like South Korea and so on. size of the European market dwarfs everybody else. The total size of the emission trading scheme is $900 billion. The European one is 750. So this one is the big kahuna by a country mile. And if you look at all the others, they have, everyone has their own different regulation, so they're not the same. And then you also need to think about, we had a slight discussion on Twitter yesterday about with one guy about he prefers the voluntary carbon market. The voluntary carbon market is a completely different animal. Okay, that's the first thing to say about it. So whereas the voluntary carbon market is typically where you plant a tree, say, or you want to plant a forest. The tree takes 15 years to grow to maturity. You hope it survives pests, fires, hurricanes, whatever, and it matures into what it's supposed to do. But it takes 15 years. And by the way, eventually, if you've decided you're going to have let's call it a 20 hectare forest, then a tree dies, so you've got to replant. So that's fine. That's what they typically do. So they always have the same number of trees. But the tree which has died is now decomposing. So actually, you need to plant a few more trees to recapture the decomposing of that one. So actually, for me, the forest thing, A, takes a long time, and B, is actually an infinitesimal game because you can never carry on planting to that extent. I'm not saying that we don't need them. We do need voluntary. The problem with the voluntary market today is that it is $1 billion, right? 700 times smaller than the EU. And you've got over 12,000 projects in there, which means that, on average, a project is $80,000, give or take. So the liquidity getting in, everybody is open to with welcome arms when you want to invest in a company. You try getting out. And the problem is that each project is completely different to the other one. Each one requires a whole set of due diligence and time and effort, and you need to value them as well individually based on your projected cash flows, which are going to differ to somebody else's projected cash flows and so on. So it unfortunately, because I want it to work and we need it to work, today investing in the voluntary market is really difficult. Okay, and actually, there's also the issue of double counting, fraud, blah blah blah. Right, whereas the EU market, the emission trading scheme, is one product, right? Completely fungible. You don't even have to do the due diligence because the EU's done it for you, and it has an indefinite life. So you buy one of those things in 2008, you could use it in 2023, 4, 5, 6, 7, 8, 9, 30, whatever. I'm not quite sure how I got to that point, but I think it's important to understand that differential between the two. And then the final point is that what the voluntary market ultimately is doing is saying you can pollute as much as you like. You can decide how much of that, if any, you want to offset, i.e. between 0 and 100. The EU ETS is saying you will reduce your emissions. Completely different. One is about reduction, and the other is about offsetting as much as you like. I'm not saying that people don't offset, but it is voluntary. So it's a completely different kettle of fish. So if you want to, and the impact of holding an EU allowance is immediate. It's not 15 years down the line. It's not about the trees decomposing and having to recapture. It is you force the price up. Industry has to reduce their emissions.
What about indirect ways of getting exposure to the carbon space? I mean, are there certain companies or other ways that people can get access without going directly to the physical?
Well, I mean, yeah, you can play the futures, but as I said, but your ETF, so you buy a ETF or whatever it may be, but ultimately it's a much more diluted way to play this. And what do you own? You can't, if you own a Kukubi token, for example, you can sit down at a dinner table and crow to your mates that you've got something which has forced emission reductions in Europe. Or forget Europe, forced emission reductions on the planet, right? Happens to be in Europe, but doesn't really matter where it is. If you've got an ETF, you don't really have that. You don't have that asset. You've got a slice of something which has 40 times less impact and blah, 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 blah. In terms of companies, I know the company. So, for example, I spoke to the CEO of RWE, which is a German electricity company, which was/is the biggest polluter in Europe. And I sat down with Marcus in January 2018, and I said to him, look, normally I'd ask for an hour of your time because I'm an analyst and all that. This time I'd like to offer you an hour of my time, and I'd like to tell you about carbon, because if I'm right and you do nothing, your company goes bust. And on the back of that conversation, and hopefully he had other conversations with other people too, he went and spent 2 billion euros buying carbon allowances, which has given RWE a position of a really good position of carbon allowances, which ultimately is worth a lot of money to them. But it's an indirect way of playing it. Why would you do that when you can buy a Kikubi token, which, if you're buying that, for example, with RWE, you're not just buying those carbon allowances. They've got renewables, offshore, onshore. You've got to look at their capex program. You've got to look at a multitude of other factors, which just dilutes the whole impact. Why don't you just own a Kikubi token or an ETF, whatever? I mean, you just want to own the direct exposure at the end of the day. You've got speculators left, right, and center. That not only are they financial speculators, but also, all these companies. If you look at the big electricity companies, the big oil and gas companies, they've all got their trading desks. The big chemical companies, and yes, they have to buy their compliance allowances for the end of the year, but during the year they're speculating too. So it almost amuses me if politicians come out and say, oh, this is all due to speculators. Well, yes, but not the speculators you're thinking about. But, in the case of Kikubi, as I said, the flow is easy. You put your $1,000 down, we buy the EUAs, you get the token. And when you want to sell, we reverse that process. Either you get if you can take delivery and want delivery of the EUAs, you can have that, or you get your cash. So what happens is that almost on a daily basis, the EU, German government, and Polish governments, because they decide to do it themselves, have auctions, right? And you can see these on the EEX platform. It tells you the actual daily auctions. They're about 1.7 million a day, that kind of thing. So the auctions happen, but then at the same time you have or beyond that you have the secondary market, futures market, and everything else. Yeah, you've got to remember that the EU is a club, and like all good functioning clubs, it needs majority. So if somebody says, we need to change something, they need what they call a qualified majority, and they have Parliament, they have Council, and then the Commission itself. The Council members are appointed, the 27 members are appointed by governments. Parliament are elected members, and then the Commission is a commission. So you need not only a majority in each one of those bodies, in the Parliament and Council, Parliament and Council, but you then need Council and Parliament to agree and the Commission to agree. So it's quite a convoluted process to change a law. I've covered utilities for 35 years, and I've learned one thing is don't trust the governments. Don't trust regulation unless you have people being if, for example, the politicians have their back against the wall, then they have to give you something. For example, when Brazil had a big fight with the energy minister there, saying you're running out of electricity. No, I'm not, he said. Yes, you are. No, I'm not. He did. And when he did, well, he lost his job. But anyway, but Brazil had to change the rules and give more return to investors. So if you've got your back against the wall, or if you've got your hand in the cookie jar, and the EU has a huge fist in a huge cookie jar. This is the 60 billion euros of finances, which the moment they tamper with this, they had a deliberation over the last 3 years about changing something, and the market just said, "Ooh," and the price tanked 20 euros. And the politicians realized and said, okay, all right, that's not going to work. That was just a debate. But for them you will know long time in advance what's potentially is going to change. But I can tell you one thing: at 80 euros, which is where we are today, the price of carbon is nowhere near high enough. Right? It is not high enough to trigger industry to change their habits, and therefore it needs to go up 3 times from where it is today. So the history of the EU is they work in phases. The first phase was 2005 to 2007, and that's when I realized the carbon price is going to go to zero from 30, which it did. And that was what they call the test phase. And the reason it happened, by the way, was because I figured out that actually people had lied about their emission levels. They'd exaggerated them because they were going to get free allowances, and the EU had no idea what the level was, and they just gave them free allowances. And then they had excess of these allowances floating around, and the system crashed. Then from 2007, 2006, well, end of 2006, 2007, they audited the numbers, and then they realized the problem they had. So in 2008, they completely reset the bar. So, right, okay, now we know what the emissions are because they've been audited, and they audited every single year. We have a straight line decreasing from 2008 all the way to 2030, and that is our supply line. And that was coming down by about 2.2% per annum. And then now that they have made the 2030 climate targets more aggressive, so instead of a 40% reduction on 1990 levels, they're now going for 55%. And incidentally, they put more onus on the EU ETS system. They're requiring EU ETS industries, which are about 40% of European emissions, to reduce their emissions by 62%. Not 55. So it tells you something about the mentality where they got the prime weapon and they make it even more aggressive. So they have the reduction of 2.2% per annum is going up to about 4% per annum. So it is think of it as a straight line reduction. So it is fixed, and that's why the system is odd, because you've got one supplier with a fixed supply per annum. But it allows me as an analyst, I think it's a unique situation where I have a pretty damn good idea what demand is doing, and I have a super good idea what supply is doing. So I know both the demand and the supply side of the equation. I can't think of any other commodity around the planet where you can do that. So for me, there's a lot of certainty in here. And yes, demand will oscillate one year or the other, as we've seen the last 2 years. But if you went back, right? So if you just go back and think about this another way, if at the beginning of last year, you said this year we're going to have awful inflation, we're going to have terrible social issues, we're going to have a massive recession, and we're going to have a war, and despite all of that, the EU is going to not only stick to its climate guns, but actually make them tougher, you'd have laughed your head off. But that's what happened, right? So we've gone through that terrible year, and still this year, still the dregs of recession going on, and the EU is sticking to its guns. Not only sticking to its guns, but actually made them, as I said, far tougher than before. I'm completely with you. I'm as cynical as they come when it comes to governments and regulation. I've had 35 years of it, but in this case, and a very few others, I can see why they're sticking to their guns. Do I believe in a global carbon price one day? I don't think so. I just think it's hard enough as it is. I mean, we've already had the UK separate from Europe for other reasons, I guess, but nevertheless separate. Could they realign at some point? Maybe once all the divorce toys have been thrown out of the pram. But I just don't see a global thing. So therefore, I don't see convergence. In terms of the price ceiling, so the EU sees itself as having covered a significant price rise, which is good. That's they think that they're on top of that. And basically what it says, you've got something called Article 29A, and Article 29A says that if the price has gone up too fast, then we'll throw some more supply into the market. What's too fast? If the average price over the last 6 months is 2.7 times greater than the average over the last 2 years, then we will throw 100 million additional supply into the system. Under my price forecasts where we got 150 next year kind of thing, that does not get triggered. So I can't. I suppose I could try and work out. Well, it depends how fast it goes up and everything else. There's a lot of moving parts, but is that number 200? I don't know. The interesting thing too is that if you put 100 million in, you'll still have a deficit. And actually, I think when the market works that out, the price goes even higher.
Lawson, I'm curious for you, given that you've done a lot of these media rounds talking about this, and obviously it's a part of the investment environment you're excited about. I understand the link to the company that you're engaged with, but what's your motivation, kind of spreading the word around the importance of carbon credits? Is it something that you just believe in as a system, or something that's more of a kind of a layup investment that people should be aware of?
Well, it's both. I started off by forecasting it and forecasting the price, and I'm an analyst by heart, and that's what I was doing, and I seem to be getting it reasonably right. So that's always nice little ego boost. And then I got to the stage in October, where are we now, 21, thinking, okay, I'm getting a bit bored of this. There must be something else I can do other than just forecast the price of carbon. And then I was thinking about retirement as well. And then in about this time last year, a bit earlier, January last year, I thought, solid, I'm giving up the day job. And then something interesting happened. What I thought was retirement changed into career change. So I've had about, 25 job offers. You kind of think, where were these people when I needed them? And then you begin to think, well, actually, if we get this right, and I can leave some kind of legacy here and be part of this legacy, not leave the legacy of actually making a difference, then that's good. But as I say to people, if you can buy, sorry to repeat it, but you can buy a Kukubi token, and you can buy it for two reasons. You can buy it because you want to be super green, because it is, in my view, the most green thing you can do, or you can buy it because of an investment. And as investment is great because, as I said, you get a portfolio diversification where you're reducing the risk of your portfolio, and you got an increase in the reward because of the way I see the price going. The bottom line tends to be, when the shit hits the fan, people care about their money and not green or anything else. But it doesn't matter what you think, because you can invest in this. You can buy this because you want it as an investment and you get super green for free, or you buy it because you want to be super green and you get a great return for free. I mean, take your pick. It doesn't matter, but you're doing both. So my motivation in the past has been about calling the investment right, and I still like doing that. I mean, I want to help people make money, and at the same time, you've got the super green thing. So it's take your pick. It's both.
I think that's a good place to wrap this Twitter space up. Everybody, please make sure you follow Lawson Steele here on Twitter. Thank you, Lawson. Really do appreciate it.
Yeah, my pleasure, guys. Okay.